Hello and welcome to our special coverage of the monetary policy that's going to be announced in the next 14-15 minutes. This coverage comes to you straight from Mint Street, and joining me from the CNBC-TV18 studios is my colleague Ritu Singh. Good morning, Ritu. If you can quickly first summarize the poll that you did.
Well, it's a status quo policy all through, whether it's the repo rates or the stance of the policy. No change is expected, largely because of the mixed cues that we're getting, whether it is the inflation data, where, vegetable prices will perhaps lead to a spike in the numbers we see in July and August. Core inflation, on the other hand, is showing some signs of easing. On the domestic front as well, on the economy, there's steady parameters. As far as the first rate cut is concerned, that's what we asked a lot of our respondents. 60% are only seeing it in the first quarter of the next financial year, with some expecting it in the quarter before or after. No changes expected in the stance. Like I said, on CPI, there could be a marginal upward revision to the average forecast of 5.1%, perhaps to 5.2 to 5.5% kind of a range. The GDP forecast, which is at 6.5%, is likely to be left unchanged for now. But the governor may sound a little more hawkish, because of, the worries on inflation. And of course, what is happening globally. So overall, not much expected on the headline numbers. We'll watch out for the fine print.
Yeah, that point is taken, Ritu, but as the days come in and we realize that veggie inflation is not going away, what I picked up from dealers is that they will very closely watch how much inflation is upped by. The current quarter, July, August, September, could be upped. At the moment, the forecast is 5.2. It could go all the way to 6 plus, 6.2 or thereabouts. And the second half, which at the moment the average is 5.3 for Q3 and Q4, could be taken closer to 6. And more important is April, May, June for next year of FY24, FY25, which was forecast at 4.5, could be upped closer to 5. So how much they are upped is what the market is watching. And of course, the governor's language, as you correctly pointed out, whether he says we will look through or whether he will say there are dangers of a generalized inflation. But our experts are there to take us through what we should watch out. Parul Mittal-Sinha, the head of Treasury from Standard Chartered Bank. We have Indranil Pan, the economist from Yes Bank. We have Kaushik Das, the economist from Deutsche Bank, and Sandeep Bagla, the CIO, the Chief Investment Officer for Debt Funds from Trust Mutual Fund. Ladies and gentlemen, thank you very much. Let me start with you, Kaushik. What would be a believable or an acceptable number in terms of inflation forecast increase?
Yeah, Lata, so people will look out for that July-September forecast which you talked about. So we have our own forecast at 5.8 for that quarter compared to the 5.2 that RBI has given. I think it can be between 5.8 to 6. 5.8 is reasonable. After that, I think, October, December and January, March, RBI doesn't need to change the forecast from 5.4 and 5.2, because in our forecast, we think by September, inflation will again come back below 5%. So July will be about 6.7, August would be close to 6. And then by September, we would expect all this disinflation to play out and inflation could be again below 5%. So I think the average works out to 5.8. And then, RBI can keep the 5.4 and 5.2 unchanged. Their full year forecast of 5.1 probably will go back to that 5.2%, which they had given in April. So it's more of a volatility in between in certain months. But if you see the underlying inflation trend, if you take inflation excluding vegetables, it's at about 5.2%. Core inflation is at 5.2%. So on that basis, RBI does not need to react today. But I'm very wary when consensus is always on one side and everybody is saying that RBI will not hike. You can't rule out the possibility that RBI comes and hikes 25 basis points, surprising the market. And they have done it in the past. Because you're talking about growth in April, June at 8% is what RBI has forecasted.
Kaushik, but let me, we don't have much time, Kaushik. Let me go over to the other guests. Parul, in case the inflation forecast for the second half and for the first quarter of next year is raised, how is the market likely to react?
So the market is already pricing in a lot of caution and fear. So if the inflation forecast for full year is raised by something like 20 basis points, going from 5.1 to 5.3, that is largely priced in. What market will really move on is if RBI sounds so hawkish, like they stand ready to act, Nobody expects a hike in this MPC, but if they give signs that they're going to hike in the next one, that's what's going to move the market. And just to add to that, market is already pricing in a 50% chance of a hike in next MPC. However, what we think is RBI is going to lean against the wind. When inflation prints were coming lower than market expectations, they sounded more hawkish than market expected. This time, they may sound more balanced, also talk about the core inflation, where the softening or the containment of core inflation continues to happen. They might focus more on that and might give some measure of relief to the market.
Okay. So Kaushik expects that perhaps inflation forecast may not be increased the second half and next year, and you're hoping that they will lean against the wind. Sandeep Bagla, what are you looking out for in the policy? How may the bond markets react if they were to raise the inflation forecast more than expected?
Good morning, Lata. It's very clear that since the last policy, Brent prices have gone up, food prices have gone up, inflation has come down, but it's likely to go up again beyond 6.4, 6.5% this month. And it's going to remain elevated for 2 months, at least 2 to 3 months. So in the near term, RBI will sound hawkish, will have to act hawkish. And while there may not be any there will not be any action on the rate front, I think the markets will try to see through this phase of high inflation readings. And if the inflation estimates are raised, I think market would be right to get slightly spooked, and there could be a sell-off. I am told the internals of the inflation numbers are quite good, and if you were to remove the food inflation, the inflation numbers don't look so daunting at all. So I think it's a range-bound market, and we do not want any extra hawkish reaction from the RBI, and we will wait for more data to emerge, and I think market will be range-bound, but it's on a cautious note. As Parul said, that there is possibility of some rate hike built in already in the rates in the next policy. Even that seems unlikely. So I think market should be range-bound.
Mr. Indranil Pan, what are you penciling in for this policy? Could we be surprised from what we're expecting largely to be a status quo policy? And on the inflation front as well, from 5.1% average, what kind of revision do you expect?
Obviously, the inflation projection of the RBI has to be revised higher by about, say, 20 basis points for an average for the year. Having said that, I don't think there is any change in this policy because one, obviously, the core inflation is trending down and is expected to trend down. Second, even if there is a medium-term miss in terms of the 4% handle that they were trying to achieve as per the last MPC policy, I think there are a lot of things that they would need to watch out at this point in time. In the sense that, first of all, I think they need to watch out whether the food price inflation also sort of manifests. The tomato goes into the onions goes into the potato. What is happening to the cereal prices? What is happening to the global edible oil prices, etc., needs to be watched out. And whether that is leading to any increase in the inflation expectations model, which was trending down over the last 2 policies. So I think these are some of the inputs that they would have to factor in, which is too early to do in this August policy, and hence they'll have to wait it out for a little more time before the whole understanding of the inflation dynamics is there and how it has its implication on the expectations model. My last point is, do note also that global commodity prices have found their floor very clearly, and they are trending up to a certain extent, including oil. While oil may not have a direct implication for the headline CPI inflation immediately, but it can have a very indirect implication in terms of some of the commodity prices going up, in the fiscal being a worry,
Sure.
in balance of payments being a worry, and therefore the currency.
Sure. Parul, we just have less than a minute to go. So any other fine print that you'd be looking out for apart from inflation that we've discussed? Anything on liquidity at all? Of course, it's comfortable at the moment.
Yes, so market is going to watch out for any comments on liquidity. Liquidity surplus is currently close to 4 trillion INR, Any signs of RBI being uncomfortable with that kind of surplus will also have an impact on the shorter end of the yield curve, both in OIS and in bonds. Market is cautious already. We don't expect RBI to do anything on liquidity, but that's something that market is definitely watching out for.
Namaskar. This is the bi-monthly monetary policy statement for August, and this is how it goes. As we celebrate India's 77th Independence Day in a few days, I am happy to note that the Indian economy is exuding enhanced strength and stability despite the massive shocks to the global economy in recent years. Our economy has continued to grow at a reasonable pace, becoming the 5th largest economy in the world and contributing around 15% to global growth. We have also made significant progress towards controlling inflation. Our banks remain healthiest in more than a decade, with historically high levels of capital, declining levels of non-performing assets, and rising profitability. Corporate balance sheets are robust with lower leverage, improving debt servicing capacity, and strong profitability. Lower current account deficit and ample capital flows have imparted strength to our external sector. The resultant accretion to foreign exchange reserves has provided a buffer against external shocks. Overall, India's strong macroeconomic fundamentals have laid the foundations for sustainable growth. In a moment like this, we need to continue with our efforts to maintain macro-financial stability while pushing our growth frontier further. India is uniquely placed to benefit from the ongoing transformational shifts in the global economy in the wake of geopolitical realignments and technological innovations. A large economy marching ahead with vast domestic demand, untapped resources, and demographic advantages, India can become the new growth engine for the world. In this background, the Monetary Policy Committee met on 8th, 9th, and 10th of August. After detailed deliberation on all relevant aspects, the Monetary Policy Committee decided unanimously to keep the policy repo rate unchanged at 6%, 6.5%. It's 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate stand at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. Let me now explain the MPC's rationale for these decisions on the policy rate and the stance. Headline inflation, after reaching a low of 4.3% in May 2023, rose in June and is expected to surge during July-August, led by vegetable prices. While the vegetable price shock may reverse quickly, possible El Nino weather conditions, along with global food prices, need to be watched closely against the backdrop of a skewed southwest monsoon so far. These developments warrant a heightened vigil on the evolving inflation trajectory. The cumulative rate hike of 250 basis points undertaken by the MPC so far is working its way into the economy. Nevertheless, domestic economic activity is holding up well and is likely to retain its momentum despite weak external demand. Considering this confluence of factors, the MPC decided to remain watchful and evaluate the emerging situation. Consequently, the MPC decided to keep the policy repo rate unchanged at 6.5% with preparedness to act should the situation so warrant. The MPC remains resolute in its commitment to align inflation to the 4% target and anchoring of inflation expectations. Further, with monetary transmission still underway, and I have given some details in the footnote of my statement with regard to this, when I say monetary policy transmission is still underway, there are some additional information given in the footnote. Those of you who are interested may have a look at it. Further, with monetary transmission still underway and headline inflation remaining higher than the 4% target, the MPC decided to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. I would now like to provide our assessment of the growth and inflation scenario. First, I would like to take up global growth. The global economy continues to face daunting challenges of elevated inflation, high levels of debt, tight and volatile financial conditions, continuing geopolitical tensions, fragmentations, and extreme weather conditions. Belying earlier apprehensions, a number of economies have demonstrated remarkable resilience, and the grim prospects of hard landing appear to have receded. Nevertheless, global growth is likely to remain low by historical standards in the current year and also in the next few years. Despite upward revision in the global growth forecast for 2023 by the International Monetary Fund. World merchandise trade volume growth is projected by the WTO to decelerate from 2.7% in 2022 to 1.7% in 2023. Headline inflation is easing unevenly across countries and remains above the target in major economies. While the pace of monetary tightening has been scaled down, policy rates could stay higher for longer. Financial markets, which had been buoyed by expectations of an early end to the cycle of monetary tightening, have turned volatile with sizable two-way movements in response to recent rating events and incoming data. Turning to global growth, these external factors are likely to impinge on the growth prospects of most advanced and emerging economies. India is, however, expected to withstand these external headwinds far better than many other countries. The momentum of overall economic activity in India continues to be positive. On the supply side, crop sowing has picked up with steady progress in the southwest monsoon. The temporal and spatial distribution of monsoon has, however, been uneven. Industrial activity is holding ground, as is evident from the latest data on Index of Industrial Production, that is IIP, Core Industries Output, and Purchasing Managers Index, that is PMI for manufacturing. Buoyant services activity is reflected in healthy expansion in e-way bills, toll collections, railway freight, and a sharp jump in services PMI. On the other hand, commercial vehicle sales and domestic air cargo traffic contracted during Q1 of the current financial year. Aggregate demand conditions continue to be buoyant. Among urban demand indicators, domestic air passenger traffic, passenger vehicle sales, and households credit are exhibiting sustained growth. In the case of rural demand, tractor and fertilizer sales improved in June, while two-wheeler sales moderated. High growth in agricultural credit and improving sales volume of major fast-moving consumer goods, that is FMCG companies, suggest incipient recovery in rural demand, which will be reinforced by improving Kharif prospects. So what I have done under growth is that first I highlighted about the supply conditions, the supply side factors. Then I have highlighted the aggregate demand conditions consisting of both rural and urban demand. And let me now turn to investment activity. Investment activity gained further steam on the back of government capital expenditure, rising business optimism, and revival in private capex in certain key sectors. Continued increase in import and production of capital goods further reaffirms this trend. Construction activity also remains strong in first quarter of this year, as indicated by healthy growth in cement production and steel consumption. Capacity utilization in the manufacturing sector at 76.3% remained above the long period average, remained above the long-term average of 73.7%. The total flow of resources to the commercial sector from banks and other sources taken together has increased by rupees 7.5 lakh crore during the financial year 23-24 so far, that is up to July 28th, as compared with 5.7 lakh crore a year ago. So just to repeat the figures, the flow of resources to the commercial sector in the current year so far is 7.5 lakh crore, and in the corresponding period of last year it was 5.7 lakh crore. On the downside, however, merchandise exports and non-oil, non-gold imports contracted further in June, and the growth in services exports decelerated amidst slowing external demand. Looking ahead, these underlying developments and the upcoming festival season are expected to provide support to private consumption and investment activity. The spillovers emanating from weak external demand and protracted geopolitical tensions, however, pose risks to this outlook. Taking all these factors into consideration, real GDP growth for 2023-24, that is for the current year, is projected at 6.5%, with Q1 at 8%, Q2 at 6.5%, Q3 at 6%, and Q4 at 5.7%. Real GDP growth for Q1 of next financial year, that is 24-25, is projected at 6.6%. The risks are evenly balanced. Let me now turn to inflation. The moderation in headline inflation to 4.6% in Q1 of 23-24 was in line with the projections set out in the June MPC meeting. There was pickup in headline inflation to 4.8% in June due to an upturn in food inflation. On the positive side, inflation excluding food and fuel, that is core inflation, has softened by more than 100 basis points from its recent peak in January 2023. The month of July has witnessed accentuation of food inflation, primarily on account of vegetables. The spike in tomato prices and further increase in prices of cereals and pulses have contributed to this. Consequently, a substantial increase in headline inflation would occur in the near term. Going by the past trends, vegetable prices may see a significant correction after a few months. The prospects of Kharif crops have also brightened thanks to improvement in the progress of the monsoon. Uncertainties, however, remain on domestic food price outlook due to sudden weather events and possible El Nino conditions in August and September. August and beyond. Global food prices are also exhibiting a hardening bias on renewed geopolitical tensions. Crude oil prices have firmed up in the recent weeks, and its outlook is clouded by demand-supply uncertainties. Assessment of the future trajectory of inflation is a continuous process. We have a choice to modify our inflation projections in every meeting of the MPC if warranted, in the interest of better guidance, or avoid frequent changes and revise them only on fewer occasions for simplicity of presentation. Given the continuing uncertainties, our latest CPI inflation projection for 2023-24, assuming a normal monsoon, is revised to 5.4%, with Q2 at 6.2%, Q3 at 5.7%, and Q4 at 5.2%. Let me just repeat these numbers for better clarity. CPI inflation projections for 2023-24, that is for the current year, assuming a normal monsoon, as I have said, is revised to 5.4%, with Q2 at 6.2%, Q3 at 5.7%, and Q4 at 5.2%. Further, CPI inflation for first quarter of the next financial year, that is 2024-25, is projected at 5.2%. The risks are evenly balanced. Headline inflation projection for the second quarter of 23-24, that is, for the months of July, August, and September this year, has been revised up substantially, primarily due to price shock from vegetables. Given the likely short-term nature of these shocks, monetary policy can look through high inflation prints caused by such shocks for some time. The frequent incidences of recurring food price shocks, however, pose a risk to anchoring of inflation expectations, which was underway and which has been underway since September 2022. The role of continued and timely supply-side interventions assumes criticality in limiting the severity and duration of such shocks. In such circumstances, it is necessary to be watchful of the emerging trends and the risks to price stability. We have to stand in readiness to go beyond keeping Arjuna's eye to deploying policy instruments, if necessary. I reiterate what I said in the previous June policy statement. Bringing headline inflation within the tolerance band is not enough. We need to remain firmly focused on aligning inflation to the target of 4%. With this, I would now like to take up the liquidity and financial market conditions. The level of surplus liquidity in the system has gone up in the recent months on the back of the return of rupees 2,000 banknotes to the banking system, RBI surplus transfer to the government, pickup in government spending, and capital inflows. The overall daily absorption under the Liquidity Adjustment Facility, that is LAF, was 1.7 lakh crore in June and 1.8 lakh crore in July this year. Despite such surplus liquidity, market response to RBI's 14-day variable rate repo auctions, that is VRRR auctions, was lukewarm. Instead, banks preferred to place their surplus liquidity in the less remunerative standing deposit facility, that is SDF. Although the fine-tuning VRRR auctions of 1 to 4 days maturity during this period evoked better response from the market. This essentially, let me just read it again. Although the fine-tuning VRRR auctions of 1 to 4 days maturity during this period evoked better response from the market, this essentially reflects greater risk aversion among the banks to park large funds under the main operation. In this context, it is necessary to reiterate that fine-tuning operations, that is overnight operations up to 13 days, are undertaken to deal with special or exceptional situations and cannot become a rule. In recent years, our stated stance on liquidity is to maintain adequate liquidity in the system to meet the productive requirements of the economy. Excess liquidity, on the other hand, can pose risks to price stability and also to financial stability. Hence, efficient liquidity management requires continuous assessment of the level of surplus liquidity so that additional measures are undertaken as and when necessary to impound the element of excess liquidity. Accordingly, it has been decided that with effect from the fortnight beginning August 12, scheduled banks shall maintain, I repeat, scheduled banks shall maintain an incremental cash reserve ratio, that is ICRR, of 10% on the increase in their net demand and time liabilities, that is NDTL, between May 19th and July 28th. I would like to read this sentence again so that the message gets across. It has been decided that with effect from 12th of August, scheduled banks shall maintain an incremental CRR, that is ICRR, of 10% on increase in their NDTL between May 19th and July 28th. And what I'm now going to say is equally important. This measure is intended to absorb the surplus liquidity generated by various factors referred to earlier, including the return of rupees 2,000 notes to the banking system. This is purely a temporary measure for managing the liquidity overhang. Even after this temporary impounding, there will be adequate liquidity in the system to meet the credit needs of the economy. We have reviewed the position, and on that basis alone, on the basis of our internal assessment, I am making this statement that even after this temporary impounding, there will be adequate liquidity in the system to meet the credit needs of the economy. The incremental CRR will be reviewed on 8th September or earlier with a view to returning the impounded funds to the banking system ahead of the festival season. I must add that the existing cash reserve ratio, that is CRR, remains unchanged at 4.5%. I would now like to focus on financial stability. The Indian financial sector has been stable and resilient as reflected in sustained growth in bank credit, low levels of non-performing assets, and adequate capital and liquidity buffers. Macro stress tests for credit risk reveal that scheduled commercial banks would be able to comply with the minimum capital requirements even under severe stress scenarios. There is, however, no room for complacency because it is during tranquil and good times that vulnerabilities may creep in. Hence, buffers are best built up during these periods. A stable financial system is a prerequisite for price stability and sustained growth. This is a shared responsibility in which regulated entities like banks, NBFCs and others are important stakeholders. On its part, the Reserve Bank remains steadfast in its commitment to safeguard the financial system from the emerging and potential challenges. We expect the same from the regulated entities also. As regards the external sector, India's current account deficit was contained at 2% of GDP in 2022-23 as compared with 1.2% in 2021-22. Merchandise trade deficit has narrowed in the first quarter of the current financial year, that is 23-24, with contraction in imports exceeding contraction in exports. Services exports and remittances are, however, expected to provide cushion to the current account deficit. We therefore expect the current account deficit to remain eminently manageable during the current financial year also. On the financing side, foreign portfolio investment, that is FPI flows, have remained buoyant in 2023-24, that is in the current year so far. Net FPI inflows have been US dollar 20.1 billion up to August 8, which is the highest since 2014-15. In the corresponding period of the previous year, there were net outflows of 12.6 billion US dollars. The inflows under external commercial borrowings also witnessed a turnaround with net inflows of 6 billion US dollars during April-June this year, as against net outflows of 2.9 billion US dollars a year ago. Net foreign direct investment, that is net FDI flows to India, on the other hand, fell to $5.5 billion during April-May 2023 from 10.6 billion a year ago, reflecting a global slowdown in FDI inflows or in FDI flows. Latest available data suggest that India's external debt to GDP ratio improved to 18.9% at the end of March 23 from 20% at the end of March 2022. The Indian rupee has remained stable since January 2023. Foreign exchange reserves have crossed the mark of US 600 billion. The umbrella has gathered strength, and I am not saying this in the context of the monsoon rains. I would now like to proceed and announce certain additional measures. As you would be aware, we announced several measures as a part of the MPC statement, and a number of these measures have very far-reaching consequences, and they make a lot of impact on our overall financial inclusion, on our financial, on deepening of credit, on the spread of UPI, and on other aspects of the economy. So we have a few measures. I request your continued patience. The first announcement relates to review of regulatory framework for financial benchmark administrators. It has been decided to revise the extant regulations issued in June 2019 and put in place a comprehensive risk-based framework for administration of financial benchmarks. This will cover all benchmarks related to foreign exchange, interest rates, money markets, and government securities. The revised directions will provide greater assurance about the accuracy and integrity of the financial benchmarks. The next announcement relates to review of regulatory framework for infrastructure debt fund NBFCs, that is IDF NBFCs. At present, infrastructure debt funds provide refinancing facilities for lenders in the infrastructure sector. The extant regulatory framework for IDFs has been revised. The key changes in the revised framework are: 1. Withdrawal of the requirement to have a sponsor for the IDFs. 2. Allowing IDFs to finance toll operate transfer, that is TOT projects, as direct lenders. 3. Permitting IDFs to raise funds through ECBs. And 4. Making tripartite agreements optional for PPP projects. These changes are expected to further augment the capacity for infrastructure financing in the country. The next announcement relates to greater transparency in interest rate reset of equated monthly installments based floating rate loans. Now let me just read it again. I think that was too long. The next announcement relates to bringing in greater transparency in interest rate reset of EMI installment based floating interest loans. It is proposed to put in place a transparent framework for reset of interest rates on floating interest loans. The framework will require regulated entities to, again, there are various components. it will require the regulated entities to, number one, clearly communicate with borrowers for resetting the tenor and or the EMI. Number two, provide options for switching to fixed rate loans or foreclosure of loans. Three, disclose various charges incidental to the exercise of the options. And four, ensure proper communication of key information to the borrowers. These measures will further strengthen consumer protection. The next announcement relates to consolidation and harmonization of instructions for supervisory data submission. The Reserve Bank has from time to time issued several guidelines on submission of supervisory returns by the supervised entities. It has been decided to consolidate and harmonize such guidelines into a single master direction to reduce compliance burden and to promote greater ease of doing business for supervised entities. And the next announcement, actually there are three announcements within this announcement, and it relates to UPI. And basically the announcements are related to bringing in conversational payments and offline capacity on the UPI, enhancement in transaction limit of small value offline digital payments. The details are as follows. With the objective of harnessing new technologies for enhancing the digital payments experience for users, it is proposed to, number one, enable conversational payments on UPI, which will enable the users to engage in conversation with artificial intelligence powered systems to make payments. Number two, introduce offline payments on UPI using near field communication technology through UPI Lite on device wallet. And number three, enhance the transaction limit for small value digital payments in offline mode from rupees 200 to rupees 500 within the overall limit of rupees 2000 per payment instrument. These initiatives will further deepen the reach and use of digital payments in the country. And this is the final announcement, the next one, and it's really impactful. We expect this announcement going forward will have a huge impact on our credit sector. The Reserve Bank, in association with the Reserve Bank Innovation Hub, started a pilot project in September last year for frictionless credit delivery through end-to-end digital processes, starting with Kisan Credit Card Loans, that is KCC loans. The pilot for KCC loans is currently operational in select districts of Madhya Pradesh, Tamil Nadu, Karnataka, UP and Maharashtra. Recently, dairy loans have been included in the pilot project in select districts of Gujarat. Based on the learnings from the pilots and to expand the scope of end-to-end digital lending processes, a public tech platform for frictionless credit delivery, I repeat, a public tech platform for frictionless credit delivery is being developed by the Reserve Bank Innovation Hub. The platform is intended to be rolled out as a pilot project in a calibrated manner. It will have an open architecture and open application programming interface, that is API and standards, to which all financial sector players can connect seamlessly. This initiative will accelerate the penetration of credit to the hitherto underserved regions and further deepen financial inclusion in our country. Let me now conclude. We have made good progress in sustaining India's growth momentum. While inflation has moderated, the job is still not done. Inflationary risks persist amidst volatile international food and energy prices, lingering geopolitical tensions, and weather-related uncertainties. In charting the course of monetary policy, we continuously assess the impact of our past actions, the evolving inflation dynamics, and the implications of the incoming data for the economic outlook. I reiterate our commitment to align CPI inflation to the 4% target on a durable basis. We do look through idiosyncratic shocks, but if such idiosyncrasies show signs of persistence, we have to act. As we prepare to celebrate the Independence Day, the air is filled with hope and promise. Let me end by recalling the prophetic words of Mahatma Gandhi. And it is as follows. I have no doubt that our country would rise to the greatest height among the nations of the world. Thank you. Namaskar.
Okay. I think the inflation numbers are going to be holding center stage. It's perhaps a little more than what the market was prepared for, going by some experts, but our poll definitely threw up this kind of an expectation. 6.2% is the current inflation expectation for the current quarter, the forecast from the Reserve Bank, and for the subsequent third quarter as well, they've increased it to 5.7 from the earlier 5.4, but Q4 is held unchanged. For the full year, there's a full 30 basis point increase in inflation expectation. That is the inflation forecast, 5.4%. That's, pretty much close to 5.5 and 6. So I think expectations of rate cut have definitely got to be pushed back. I think the biggest surprise comes in the Q1 for next year, which has been increased to 5.2. The earlier number was 4.5. So it's a 70 basis point increase. I think that's going to push back rate cut expectations even beyond April, May, June of next year. We have to probably push it to July if this is the expectation, unless the year ahead inflation expectations becomes much lower. It looks like clearly rate cut expectations have been pushed back. The other big announcement, of course, is that an additional CRR of 10% has to be maintained on incremental liquidity because of the liquidity increase due to the return of the 2,000 rupee notes, but that's a temporary affair and will be reviewed on September 8th. With those preliminaries, let me go over to our guests. First up, I think we have Upasana and Kaushik Das with us. We also have Rajiv from the head of the CIO debt from SBI Mutual Fund. In a bit, we will be joined by the SBI Managing Director, Mr. Sethi, as well. Okay, first thoughts from you, Upasana. What have you made of the increase in the inflation forecasts?
Lata, here I think broadly, if I look at the policy, decisions have been broadly in sync with what we have been anticipating. Our revised estimates for inflation after the vegetable-led inflation has been 5.4%. So the headline number does look in line. But I think internally, if I was to look at the quarterly profiles, the 6.2% does have an upside risk. I think the near-term risk to this quarter is much higher. While the last quarter estimates, RBI has preferred to keep that unchanged. My sense is that will be revised downwards eventually. So internally, I think there is much more upside to the near term. Going beyond FY24, like you mentioned before, we are at 5% inflation. So clearly, I think higher for longer is what the governor did emphasize, maybe in the global context, but that also remains the key even domestically. We do not look at a possibility of a rate cutting cycle happening anytime this financial year. We will have to, again, evaluate the conditions going ahead into the next year. But at the moment, I think there's more upside risk to inflation in the absolute near term. Okay.
Our bankers have also joined us. Mr. Sethi from the Managing Director from State Bank and Rajiv Anand from Axis Bank. To you, Mr. Sethi, does this change anything at all? Repo rate hasn't changed, but there is clearly an upward bias to inflation. And then there is the CRR, additional CRR announcement, probably for a temporary period. Your key takeaways?
Yeah, good morning, Lata. Thanks for having me here. And I think on the policy rates, it is on the expected lines. Of course, the surprise is on incremental CRR. The only positive point is that is going to be reviewed soon on the 8th September. So, but I don't think there's going to be a significant impact on the liquidity situation in the system. That is what my assessment is. And apart from the inflation trajectory which is projected, again, the good thing is that the Q3 onwards, the inflation as expected is projected less. That is going to be a positive. Apart from that, there are many other things governor has announced in terms of the measures. I think they're far-reaching impact. One is on the platform, the frictionless platform, what RBI has announced. Major banks like SBI are also working very seriously with RBI Innovation Hub, that what kind of products we can make it available on this platform. Similarly, the greater transparency on the interest rate of EMI floating rate interest rates is also a good step, because there was no uniformity in terms of resetting the EMI or tenure of the loans. I think this transparency, both in resetting as well as communicating to the customers, I think has been a very, very important step what RBI has announced now. These are my initial remarks.
Okay. Okay, sir, this 10% additional CRR you'll have to make will kind of lower your profit for only this quarter, July, August, September?
No, I think
there idle money, no?
There will be some impact. We'll have to assess what is the NDTL increase during the period which is mentioned, and then we will have to assess what is the impact. Now we are just working on it. There would be a slight impact, but since 8th September is also mentioned there, I think the pain going to be lesser, I suppose. Hopefully the 8th September review will probably discontinue the incremental CRR.
That's right. Only the Nifty Bank is reacting at the moment to that announcement. The Nifty Bank has gone down considerably. I think it's a 0.8 fall that it has seen. Of course, it started on the back foot, but it's just gone up. The losses have increased. There hasn't been much of a movement in bond yields. We saw a brief 7.18 when the inflation numbers were announced. After that, the bond yields have come back to 7.16. So I don't think this is MTM losses on the bond book, but clearly a little more money taken away from the banks and told to keep idle. Basically, that's what CRR is. Taking away a small portion of the deposits and telling the banks, no, you can't lend. So up to September 8th, this disability is going to be suffered for at least a month and a little more. Rajiv Anand, is it, a little bit of negative for the bank profits for the second quarter? Is that the only negative? No problem in terms of margin impact from the hawkishness of the governor?
This is a move basically to immunize the money that came in because of the 2,000 rupee action that RBI took. Our own rough and ready estimate is that the total impact to the banking system is about 1 lakh crores for this brief period. In the context of the fact that there is 2.5 lakh crores of surplus liquidity, I think the impact, whether it is on NIMs or on profits, is really minimal, because it's just for a period of a month. So I don't think the impact is going to be material at all. Secondly, I think the underlying growth, continues to be strong. Credit demand continues to be strong. I think what we have to work through is the continued, fight for deposits, and that really is going to be the theme for the rest of the year.
Okay. Okay, yeah, there will be that pressure, of course, on the cost of funds. Let me get to Rajiv Radhakrishnan as well. Rajiv, the bond yields went up, but now they're back at 7.158 or thereabout, 7.16 to be precise. You think that this is going to leave the bond yields unchanged? Your key takeaways from the policy?
Yeah, so broadly, it's a long anticipated line. So when you look at the overall set of measures that the RBI could have done, addressing liquidity, I think probably was a path of least resistance. And even within that, it is largely a one-off move on an incremental basis. You've increased the CRR. So to that extent, I think from a bond market perspective, given that a hawkish commentary and a potential upward revision in CPI estimates were broadly factored in, I think that's the broader sense that you get at this point, that market has largely been, it's in line with the broader expectations that the market had getting into the policy. But I think what's more important is RBI has very clearly, conveyed its, intent to address the surplus liquidity in the system. So to the extent that the surplus liquidity conditions continue for some more time, one may need to be cautious about incremental actions to address that.
Exactly. I mean, I don't have the near-term yield with me. I only have the CCIL index where I'm not able to get near-term yields, but there would be a pressure, right? Near-term yields, T-bills yields should go up because the near-term liquidity could be a little tighter?
I should assume so. I mean, at least on an incremental basis, in the near term, we should expect a marginal uptick at the shorter end. But what is more important is I would just reiterate that how the liquidity dynamics evolve going forward. And I think that's one segment that the RBI would be really focused on going forward.
Okay, so 7.17 now as I speak with you. That is, of course, the 10-year, but near term, the T-bill investments could take a bit of a hit because banks have slightly less loose cash. They have to keep aside a little more as idle CRR money. That's the basic message of the CRR rule that Reserve Bank has bought, but it is temporary. Remember, it's only going to hit Q2. Kaushik, I think the inflation forecasts are a bit of a nasty shock for you.
Yeah, I think RBI has kept a lot of buffer in their forecast rather than keeping on changing every policy like Governor Das mentioned. So I think they have now kept it on the higher side, and I think inflation now will surprise to the lower side compared to the forecast that they've given. So they've given 6.2 for July-September. As I told you before, my forecast is about 5.8. So I think by September you'll see a very sharp disinflation, and then the numbers will keep on surprising to the downside. And October, December also they have increased. I think there's a downside risk over there as well. The good positive part, if you have to take from here, is that they've kept the January, March 24 and April, June at 5.2, which means that even at 6.5% repo rate, your real interest rate is 130 basis points positive, which is the positive way to look at it, because monetary policy members will look at the medium-term inflation outlook, not just the month-on-month volatility, and decide on the policy front. So from that standpoint, you could argue that there's no need for further rate hike when you come to October, because by that time the disinflation process would be very much in place, unless you keep on getting repeated shocks, which is something which we don't know, and that's why RBI has kept the buffer. On liquidity, we were actually anticipating something, because for the last few weeks RBI was not doing VRRR and liquidity surplus was there in the system, so we were wondering maybe something could be there in the policy, and this has come as the incremental CRR. But remember that closer to the Diwali festival, you'll have currency circulation leakage, and then you have bunched up state elections in October, December. There could be further currency circulation leakage. So I think this measure, what has been announced, will be only used temporarily, and beyond that, RBI will probably not need to keep liquidity impounded, and you see natural tightness of liquidity coming back into the system, and they can do away with this measure that they've announced.
Okay, Mr. Shetty, coming back to you on this incremental 10% CRR, if we could get a little more from you, because we already saw a margin compression from SBI in the quarter that you just reported. In the near term, because of some of this withdrawal of excess liquidity, do you expect margins for the bank to come under further pressure?
So I don't think so. See, as Rajiv mentioned, the impact is likely to be around just about 82 to 1 lakh crores for the system, and it could be even less for SBI. But more importantly, our ability to lend is not impaired, right? So I think we have sufficient cushion in terms of the excess SLR, and the liquidity availability to us is also significant. And our deposit growth rate continues to be in the double digit. So I think on the margins front, I don't really see significant impact. And even if there is, I think it's only a short-term impact. I don't think it's a really meaningful or significant.
And Mr. Shetty, what happens to your lending rates from here on? We're looking at the CPI projection remaining above 4%, at least till the first quarter of the next year. The rate cut cycle is pushed back, at least until then, if not further. What happens to your lending rates?
So we'll have to see, what kind of emerging scenario is there. As far as, so far deposit rates, we kept reasonably market oriented. We haven't had any significant increase in the deposit rates. At the same time, as we keep saying, our deposit franchise is very strong and we would like to compensate our depositors adequately. And that has been our philosophy. And on the lending rates, there could be a small uptick if CRR carry has to be added to the MCLR. But we'll have to see whether we're required to pass on to the consumers or not. That decision will be taken by the ALCO. Broadly, I think up to March 24, the rates, lending rates and deposit rates will continue to be what they are now. I don't see any significant movement there.
Okay. Mr. Sethi, just to continue with, I thought Ritu put the finger on the right point. Would you, because there is a bit of liquidity tightness that the Reserve Bank is pointing to, the way they are behaving, would there be an upward pressure on deposits? And, even in this ability to pass on the cost of the extra CRR, do banks really have that elbow room? So again, margins question.
Yeah, no, that's what I was mentioning. That's what I was mentioning. The CRR carry may not be really significant in terms of pushing up the rates. And the deposit rates, I don't know about the system, but as far as our SBI is concerned, I think we are in a comfortable position. We have not been desperate to increase the rates of interest on the deposits. Because of our excess SLR, what we keep mentioning, which provides us adequate liquidity to fund any credit growth which comes up. So that is the reason I was telling Ritu is that there may not be a real pressure on our margins.
Okay. Rajiv, similar question to you. As the banks get smaller, I guess the top 5 banks are in a slightly better position. But is there going to be more pressure on deposits? And probably they don't have an option, but may be forced to lend. Is there more pressure on the smaller banks in terms of margins?
Lata, if you look at incremental deposits, the top 5 banks now comprise almost 50-55% of the flows come to the top 5 banks. And so therefore, by definition, the rest of the banking system is really, fighting for the balance 45%. And what you're also seeing is that the top 5 banks are continuing to increase their branch presence across the country, and they continue to invest in digital capabilities. And so therefore, if the smaller banks want to compete with the larger banks on the deposit franchise, they will need much larger investments on both branches as well as digital capabilities. Now, whether their P&Ls, balance sheets are able to support that is really moot. But the fact remains that 55% of incremental deposits is coming to the top 5 banks.
Mr. Rajiv Anand, before we go to the economists again, what the RBI said on the EMIs, they want to make it more transparent, the interest rate resetting for, loans that are equated, monthly. I just wanted to understand, are you expecting some tweak here or just more transparency in terms of disclosure to the borrowers? Any impact at all from either the customer side or the bank side? Mr. Rajiv Anand, if you can hear me.
Sorry, I didn't get that question.
On the EMI, what did you glean from what the governor said in terms of tinkering, getting more transparency in the interest rate resetting for EMIs? Will that mean some sort of changes or just more transparency in terms of disclosure to the customer? So the impact on banks as well as the borrower.
I think the focus really here is around transparency. And given the fact that almost the entire retail book particularly is now linked to external benchmarks, I think it's very important for retail customers to understand how those rates are going to change, when those rates are going to change, what is the impact on tenors, etc. So I think what RBI is pushing very hard on is to ensure that banks are being absolutely transparent on this, and we're completely supportive in terms of the actions that RBI is currently taking around this.
Okay. Well, just a final question to you, Mr. Sethi, before we let you go. On this infrastructure development fund for NBFCs, it says you don't need a sponsor anymore, and you can finance the toll operators as well. More importantly, they're allowed to raise money from ECBs. What's the net impact? More money available for infrastructure? Do you think this route will be deployed more?
Yeah, obviously, Lata, I think particularly on the toll operate transfer projects, most of these projects were completed projects, what we call TOT projects. So IDFs participating in that will enable many completed road projects to be refinanced. So there will be more funding available for the infra, and raising ECBs also would definitely diversify their funding resources and help in supporting the infrastructure spending in the country. I think these are a few, facilitators. Definitely would help them, expand their resources raising capacity.
No, let's.
Well, Upas, before we wrap up, a quick word from you as well, since we're going to be hearing from the governor. Anything you'd like to ask him, any more clarity you'd seek from whatever we've heard from the governor so far? Yeah, Upasana, go ahead. So, Upasana, we were asking if, what would you like to hear from the governor? We're going to be in a press conference with him shortly. Any more clarity you'd seek from what we've heard from so far?
No, I think the governor has been quite adequately, clear in what they really want to provide as a forward guidance. They are going to be watchful on the inflation prints, but they will probably try to look through some of the seasonality, which is bringing an upside to the inflation scenario. So I think that part is very clear. It is more on the liquidity side. While the recent measure on CRR is a temporary measure, I think somewhere clarity on what is an optimal level of liquidity which the governor will be comfortable with, that is something which would help, because going ahead, like Kaushik did mention, the second half of the year does tend to see seasonal currency leakage. Secondly, the deposit accretion that has happened because of the 2,000 rupee note withdrawal, how much of that is permanent in nature? All of this will determine the conditions on liquidity going ahead into the second half of the year, and that may eventually result in a much tighter situation than what we are anticipating today. So while this is a temporary measure, probably some more clarity on the liquidity stance. That is something which I'd want probably more clarity on.
Okay. Fair point, actually, Upasana. I'm sure everybody will want to have much more clarity on the liquidity situation and how tight would the Reserve Bank want it to be, and what is even their definition of tightness. Well, those questions as well for our guests after the break. Let me thank the bankers for their time, Mr. Sethi and Rajiv, but if I can request the economists and the bond dealers to stay on, we have a few more questions.